Hello and welcome, everyone. In true South African fashion, as you can see, we're just a few minutes late, but very, very excited to be coming to you today. We really want to just take the time first to say thank you for taking the time out, whether you're watching this live or recorded on one of the platforms. And we really hope that you found something valuable in today's session. So, going straight into it, today we have absolute experts with us to discuss the topic of digital disruption, blockchain, and financial services. So, we all know that financial services, by and large, has been the area where cryptocurrency and things like stablecoins tend to make the most sense. But when it comes to financial markets and things like financial markets infrastructure and capital markets regulation, both of which are quite a mouthful, we haven't seen the market mature as many of us would have predicted a couple years ago. Nevertheless, we all still very, very much agree that these are areas that blockchain technology and digital assets you've all, if you join us regularly, I've probably seen my face and heard my voice enough times. Just for those of you who haven't, I'm Brenton Nika. I am from the CVVC team. We're an early stage blockchain investor and ecosystem builder. But like I said, the real all-stars are the guests coming after me. So I think we should jump straight into the content today. And to start off with, we have South Africa's premier digital assets professional services provider. And not just anyone from them, but we have Dale Russell. Dale currently serves as a director and the head of digital assets at Moore Johannesburg. And if a lot of you are wondering, yes, that is the Moore that you all know and love, the accounting, auditing, and advisory firm. It probably would be a lifetime before you'd expected to hear accounting, auditing, and advisory in the same sentence as crypto and Web3. But Dale is going to be taking us through exactly why they fit perfectly into the same sentence and why professional services in the blockchain and financial services space is so key to us moving forward. So we're very privileged to have you with us today, Dale. And without further ado, Dale Russell.
Thank you very much, Benson. And thank you everyone for joining us today. As Benson has alluded to, I'm from Moore. And today I'm going to speak about what inherently is known to be a boring or, mandatory experience and the role of professional services. But I'll be alluding to the fact of how professional services have played such a trusted role in the economic history and how this is not going to change amidst a new industry. So if we can maybe just bring up the presentation, and I think where I'll start is the fact that digital disruption is what we're speaking about today. And what I think speaks highly to my main point today is that the trusted role that these firms serve and have served in the past is not going anywhere. So these firms need to and are evolving and are not dissolving. So that's kind of going to be the focus on the presentation today. So what I mean by that, and in the traditional world, the role of professional services firms ensure regulatory compliance. They enhance trust and transparency to foster customer confidence, which actually in turn, increases adoption. They advise on risk management and navigating through these uncertain times. These new industries create demand for new skills and education, and the employees and those who go through this profession are normally those providing new thought leadership around the space. public confidence, and this is something that it may sound ironic, but in a world where it is based on decentralization, there is still an element of a trusted centralized party as in a bridge of the movement between the old and the new. And I think the role of a firm, regardless of the emergence of the new industry, will adapt and play that role. And it's no different to today. So we have seen revolutions in the internet, we have seen it in manufacturing, we've seen it in IT, we've seen it in telecoms, and auditing firms need to adopt new methodology. They need to make sure they invest in the right skills, knowledge, and expertise to be able to service traditionally what they would provide to any other industry across assurance, advisory, tax, compliance, but to a niche market and being able to deal with these nuances. And I think promoting ethical practice is something that is so crucial, especially in the market sort of trend we find, where we are looking to take out bad actors and ensure that this market can mature, but in a regulated space where innovators are known where and how they can innovate in a way to promote new advances in commerce, but within the realms of what they are allowed to and not allowed to do. And the guidance of these firms, I believe, will play a pivotal role in the bridge. So if we go to more specifics on what I've just alluded to, we're going to see a disruption of traditional services, but in principle, it remains the same. So your assurance leg, whether you're auditing automobiles, mines, or any industry, you're still providing assurance over a set of financial statements and financial data for stakeholders. So when we talk about digital assets and cryptocurrencies, in principle, when we provide assurance, we still are giving. However, the method in which we do that needs to change. So we need to make sure that we have the technology, the understanding, the skill sets to be able to navigate clients through these ever-changing regulations, and how can we obtain the same objective that we do in the traditional world, but in this space. For example, asset-backed token or a stable coin, as Brenton was alluding to. We have a solution at the moment where we call it real-time reserves. Because of the power of the rails of blockchain, it enables increased transparency and efficiency, and using technology, we're able to pull data sources that are integrated from financial systems as well as from collateral providers every 30 seconds to ensure that what's represented on chain in the form of a tokenized or synthetic asset-backed token is actually verified what's off chain. And that is just one example for something like an asset-backed token. When we talk about exchanges, and we can go on and on and on about on lending and misuse of funds, there's been scrutiny about proof of reserves. However, we accept that scrutiny, and we would rather build on and take that advice to enhance our solution as opposed to walk away. So we have built a Merkle tree with proof of reserves service, which allows platforms to place public reports and Merkle tree generation tools where you can provide a hashed user ID or basically a string of text that's linked to a custom ID to protect protect their privacy. However, they can independently verify on a public website that, for example, their liabilities were included in the assessment of the proof of reserves. And we think that a standardized industry approach towards this is crucial, that everyone is adopting some sort of proof of reserves. And how I like to think about assurance in the digital asset space is that, yes, there's scrutiny around proof of reserves being a point in time, etc., but that's just one piece of the puzzle. We need to get to a point where we have standards across custody solutions. What are your internal controls, your IT controls? How are you segregating funds? Are you doing financial statement audits on top of it? And once we enforce or adopt to perform all of these pieces of assurance, we start to see a full picture. Once that full picture is done on a more regular basis, it becomes harder to have actors that want to perform, malicious actions. Becomes harder for them to do that, because you're increasing frequency, you're increasing realms of assurance, and it is quite easy to then pick up any misguiding sort of behavior. Then when you talk about advisory, so advisory services, and this spans across, we could speak all day, but essentially advisory is opening up a new realm of tokenization and access to fractionalized markets that are inherently illiquid. And these types of new capital raising models, etc. I think the role that advisory firms have played in traditional debt raising will evolve into ways that they can help do tokenization by raising capital through fractionalized ownership, as opposed to raising money at a bank, for example. And on top of that, you need to know, if you fractionalize ownership of a rental building, for instance, and your token represents a percentage of P&L, an Oracle bridge becomes important. The auditor still needs to verify what is off-chain. Does that building exist? Are those rentals real? How is that facilitated to be put on-chain? Are those smart contracts, have they been audited? Are they being executed correctly? And is what's being represented on-chain talking to what's being represented off-chain? So that trusted role to use the tech that has been built, that we have, for example, we run our own nodes, etc. And I think it will still be an important part of professional services. And when we speak about compliance, and I think now is a very topical discussion, and education and how we go about balancing over-regulation and making sure that participation is safe is very important. And knowledge around the space and experts that are able to guide you through every single guidance note that's issued and licensing process, and how that impacts your reporting and your financial plumbing, etc. I believe that if firms adopt approaches towards embracing this as opposed to walking away, we're going to assist the market in getting to maturity. For example, if you get your financial plumbing right, and I speak to financial plumbing as in your back end, if you integrate, let's say, crypto subledgers that are SOC reviewed by Big Four, etc., that are capable of accounting for, recording, and integrating with existing financial systems, then your whole process of your financial statement audit becomes easy at the end, because your plumbing is in place. So we need to build from the bottom up and make sure that we've got infrastructure in place, and we facilitate with skills and tools that can deal with these nuances, because in essence, all we're doing is changing the way we provide the underlying service. So I think that I might be running over time, but that's in essence about how I think professional services firms need to think about evolving and adapting this change, because this market's not going anywhere, and neither is the role of a professional services firm. So the challenges that we face, and I think I have spoken to this briefly, is the regulatory landscape. Inherently, we've seen that this technology enables a borderless ability to transact peer-to-peer, and we've got segmented regulatory landscapes. We've got different jurisdictions banning. We've got some states in America doing one thing. We've got some countries completely embracing it, and a drive towards a globalized or an industry standard that we can apply as a framework that's clearly outlined is something that is going to be very crucial to the maturity of this market. And I think that we as industry players, and that everyone that's on this call needs to start driving, because I think the technical expertise and the knowledge is very important to enable people to understand and grasp the implications of this, and how we should go about self-regulating before the different jurisdictions make calls that actually over-regulate and kill any sort of innovation that we can see. The transparency and anonymity is obviously something that's always spoken about, but there are methods, around ensuring there's traceability and certain ways in which you can blacklist or do your AML and KYC processes sufficient enough using RegTech, etc., to get around this. I've spoken to the technical understanding. I think this is a major lack in most places. The understanding and education is something that should be focused on, because you can't participate nor regulate nor innovate on or in a market that you don't completely understand. And we all know that this market comes with its own nuances. So driving the education push, I think, is something that also is a challenge that we need to overcome. So the integration and interoperability is always spoken about. How does this fit into our traditional system? Is it a bridge between the two? How can one chain speak to another? How does this work with the traditional banking systems, the traditional models? These are challenges that we are going to have to overcome in the future. And then obviously security risks. We need to enable procedures, policies to overcome and identify security risks, just as we have with traditional markets. I think a misinterpretation is that the first thing that often is said is, you hear the word crypto and it's a scam, but just so easily as you can go and draw cash and perform illicit transactions, it's no different. So we need to get past the understanding barrier, and if we can get to a point where in any pitch of any industry player where you actually don't mention the word blockchain or crypto, it's just that it makes it faster, it makes it cheaper, and it's going to help you in this way. Just as the internet has done. We would never have imagined an e-commerce world 20 years ago, but when someone pitches an app idea, they don't go and tell you how the coding behind the page of Amazon's app. They don't come to you and pitch that and say, oh, we used SQL and we did this, that. All that it is, look, you can buy this online. You don't need to go to the shop. It'll be delivered to your door, and it's going to arrive within X, Y date, and you can pay online. So I think we in that stage where we need to overcome the hurdles of understanding the technology, but then taking it a step further to implement it, as opposed to staying focused on the mechanics behind it, and let specialists work with that, and innovators build on it. And then lastly, before I hand over to Paul, is he's going to speak to the evolution of money on blockchains and FMI and those types of things. So I just thought, just to tie it in with how professional services firms, can talk to that, is, we can enable real-time verification on, for example, CBDCs, by using the tools and technologies that we've built, which will, increase trust. We can reconcile data from off and on chain using Oracle bridges, so that'll foster, the trust in the technology behind it. Adapting to the regulatory changes and navigating through that, and outlining the ways in which businesses can operate, will break down the barrier of those wanting to enter but are not willing to either spend or invest time into something that could be, banned tomorrow. Reg Tech Advisory, and Paul speak more to that, but integrating these security assurances is something that we all need to work together as industry players, being it the traditional banking and financial sectors, the VC and startups, along with your developers and your tech providers. And I think professional services is one also to not forget about. Although it is normally mundane and boring, it is a very important role. And I think we at Moore have adopted to embrace it, adapt to the change, build, take on the scrutiny and adjust to it, because we know this is not going anywhere, and we would rather take on comments to improve and see how we can navigate through that to be able to foster trust in community, and obviously then increase the adoption in the market in general. So I think, that pretty much sums up. I think I've might have gone over time. I do apologize. But as I said, I think professional services play an important role. And I think Paul's going to speak to a lot more interesting stuff today. I'm going to hand over to Paul Paul, I would give you an introduction, but I think I've gone over time, so I'm going to let you speak to your history, if that's okay.
Thanks, Dale. Thanks. I talked fast anyway, so hopefully we'll catch up a little bit. My name's Paul Mitchell. I've been in strategy consulting and financial services for about 25 years. In 2017-18, I founded the blockchain team at PwC. I was the blockchain and fintech lead there. Left them and started working in 2020 with Block Markets Africa. And what we do is build regulated blockchains. So we think the technology is great. We can use this in the regulated financial system, and we're focused on new business models, on the things that this can do that are new, as well as improving on the existing, and the implications particularly for incumbents. And I lead consulting for BMA. So I've just got a few slides. Hopefully this all works neatly. We believe that tokenized money is inevitable. The process that we've seen. So we saw Bitcoin appearing in 2009. The paper was written or came out in Halloween, I think it was 2008, and it's well worth the read. If you haven't read it, please do. It's only 9 pages. It doesn't mention blockchain anywhere, but what Bitcoin gave us, what Satoshi created, was this unique digital property. So the idea that I can have a unique digital thing, I can send it to you, and when I've sent it to you, I haven't got it anymore. And that's revolutionary. And I think we're still just beginning to understand all the implications of that. What then happened in 2014, 15, and then through to 2016, 17, we saw the advent of Ethereum, created by this guy and others, this guy Vitalik Buterin, We saw an explosion of innovation with different business models and more tokens, and with the ICO boom in 2017, all sorts of incredible things, an awful lot of scams and stuff, unfortunately, but also a lot of innovation. And one of the things that came out of that, we're talking about tokenized money, was stablecoins. So particularly Tether and USDC are the two biggest, both US dollar, as most stablecoins are. And the idea of a stablecoin is it's something that's basically a tool for traders initially, because people trading and speculating in Bitcoin and crypto and all sorts of other things don't want to come out of the crypto system in order to come to cash in their trade or to just store value. They want to be able to do that in something that's denominated in dollars, but it's within the system, so they can avoid coming into the banking system and all the time and cost implications of that. So stablecoins are huge use, probably the biggest use case in crypto at the moment. And then central banks got in on the act. So probably partly triggered by the Facebook experiment with stablecoins, or their threat to do stuff. Central banks started to experiment with a central bank digital currency. So a tokenized liability of the central bank. So if I want to hold central bank liability, I can only hold it in the form of notes and coins. Banks can hold an account with the central bank, but within a CBDC world, I can have potentially a digital central bank liability. And the Project Coco 1 and 2 was the reserve banks in South Africa, the reserve banks experimenting that stuff. So we've seen this progression from sort of the wild new innovation of Bitcoin through to an explosion of innovation around ICOs and so on, and CBDCs. And I want to talk about how that's kind of taken us to where we are in terms of the things we can actually do. So I'm going to get towards the end of my talk, get towards the things that we see in terms of new business models. But the regulations are here as well. So we've got this guy, Gary Gensler, who's the chairman of the SEC at the moment. And he epitomizes the sort of first knee-jerk response to crypto and new innovation things, which is to say, we've got rules already, let's just apply those rules. And the rule they have particularly is a thing called the Howey test, which is a piece of legislation from 1946. Yeah, that's not a typo, 1946. It's a case with a Florida orange farm. And what it says is, if something's a security, then if it's an investment of money in a common enterprise with the expectation of profit derived from the efforts of others, then that thing is a security. And that test is being applied to various tokens. And the SEC is busy suing Coinbase and Binance and Ripple and others. So that's one way of doing it. Take the old rules and try and apply them. In the more civilized world, we've got other ways of doing things. And again, I'm using South Africa as an example here. We've taken the old rules and said, well, actually, there's stuff in the old rules, and we can apply that to crypto because there's commonalities across crypto and across other assets. So let's just bring crypto under the current umbrella. And what we've done in SA is we've defined crypto as a financial product. We've defined CASPs, crypto asset service providers, as accountable institutions, and that brings them within some of the regulatory stuff. It's not perfect. It's kind of regulation by analogy, but it's a lot better than something like the sort of the Howey test type approach. The third option is kind of the ultimate where we are now. And so conceptually, this is the right thing. This is to say, let's create new rules that apply to this new stuff. So we have something that enables all sorts of things we haven't contemplated before. So let's have some new rules for that. And some countries were very early with this stuff. Liechtenstein had blockchain laws in 2020, I think. But this year, the European Union has released this thing called MiCA, or Markets in Crypto Assets. And that's a fairly comprehensive piece of legislation that focuses on how do you regulate this stuff, and how do you create the right sort of framework from it. It doesn't deal with some stuff. It doesn't deal with DeFi, decentralized finance. It doesn't deal with NFTs, non-fungible tokens. But it's a really good start, and it's probably going to be the basis that everybody else kind of works from, which is also a good thing because we need global consistency in this stuff. You don't want a situation where you've got a huge options for regulatory arbitrage across the world. And we have that already. I mean, that's why we have sort of tax havens and stuff. That's a form of regulatory arbitrage. But as far as possible, in something that is going to be global money, it's going to be global infrastructure, we need the regulations to be consistent. And so we're starting to get there, and we're seeing international entities like the BIS, the Bank for International Settlements, like the Financial Action Task Force, the IMF. A lot of these global organizations are starting to prescribe, here's what we think crypto legislation should look like. Here's how we think AML rules should be applied to crypto, and so on. And so those rules are starting to become more consistent, and we're seeing a consensus forming. I think there's a fourth stage beyond this, which is actually this idea of program regulation, which I think Dale touched on, which is if you've got the ability to program the system in some ways, you can actually almost program some forms of regulation into the system itself. So instead of enforcing retrospectively and trying to deal with stuff down the line, you can actually prevent some things from ever going wrong in the first place. And that's something I think we're just starting to explore, but it's quite sort of underdeveloped at this stage. So we've got this technology rushing ahead, the innovation going on, and as usual, the regulators are behind, trying to close the stable law, trying to catch up, trying to figure out what it all means. But what it means from my perspective is the pieces are starting to fall into place. So we've got the innovation coming into the mainstream, we've got regulations getting clearer, and this leads us to a place where blockchains are a basis for financial market infrastructure. And I'm going to try and explain how that works. So if you think about money and something like this, any kind of innovation forces you to go back and think about the very fundamentals of what you're looking at. So if you take anything and try and rebuild it completely, you need to go almost back to scratch. And if you've heard the Bitcoin stuff, you've heard the three forms of money, or the three functions of money, all that kind of thing. If you're thinking about banking and things, and you tend to do this if you're trying to reinvent it, or if there's a crisis, you start to recognize that not all money is created equal. So we have three types of money illustrated here. One is central bank money. It's a liability of the central bank. That little red ring on the thing there says it's a British £5 note that says I promise to pay the bearer on demand the sum of £5, presumably in sterling silver originally. That's where sterling came from, the name for the currency. But that's a liability of the central bank. All money is debt. All money is a liability of somebody. That money, the CBDC or the note, is a liability of the central bank. The second option is commercial bank money. So my bank balance is a liability of my bank. So I have a bank account with ABSA. They hold my bank balance, and it's somewhere on a database in ABSA, hopefully backed up very securely and everything else. And then the third one is mobile money, e-money, M-Pesa, that kind of thing, is a liability to the mobile issuer, the money issuer, the operator. So there's those three kinds of money, and in our deal world, they're all perfectly fungible and equivalent. And there's a sort of day-to-day life, we think of them as equivalent. I don't think if I pay in £100 Rand note and give it to the bank to put in my bank account, I don't think I've kind of degraded the quality of my money. It just feels like the same thing, and that's where we'd like to be. And the BIS calls that the singleness of money. The RLN guys talk about sovereign money. But the idea is that all these different types of money can exist on a single network. At the moment, they don't. They can exist all in the same place. And what that means is if you've got them on the same blockchain, then you can do new things with them. And the legal form of the money takes precedence, and the form of the money is secondary. It's primary to the technology. And so, in the same way that I don't care if my money at ABSA sits on Temenos or Oracle or whatever system they're using, it shouldn't matter if it sits on a blockchain. And in regulatory terms, it doesn't matter. And this is the thinking behind this regulated liability network. So a network holding regulated liabilities issued by regulated entities, banks, e-money issuers. And the BIS has written about this. They call it the unified ledger, same idea. And then the Bank of New York, the New York Fed has run an experiment with MasterCard, HSBC, Citi, Swift, a whole bunch of banks, end of last year, beginning of this year, and they published three reports on it about how the thing works. It's fine. It's in regulatory terms, it makes sense. They looked at cross-border transactions as well. So this idea that you can actually have all these different types of money and bring them together. So at the moment, those exist in separate systems. We can bring them together. Now we've taken that idea at BMA. We've kind of taken that and said, well, that's brilliant, but we can see another, what we think is another way of doing, another way of thinking about it. It's a further kind of maybe complexity, but further benefit. If you think about financial markets infrastructure more generally, we talk about FMI as financial market infrastructure. There's lots of different silos where these things sit. So we've got banking systems, we've got forex systems, we've got securities systems, and so on. And each one of those relies on a particular intermediary to deal with that certain type of regulated liability. And in the case of money, for example, we have banking systems in each different country, and we have guardrails and all these kinds of things. If you want to do something interesting, you often try to daisy chain these things together. So I want to settle a securities transaction. The transaction settles in the with the JSE or straight, and the money settles in the banking system. So you've got to kind of bring these things all together, and that's why things take so long and they get complicated. what we're saying is, well, we've got all these different things. Why not just put them on a single blockchain? So you have multiple financial asset types that exist on a single thing, and we call that open financial market infrastructure, open FMI. So a single blockchain with multiple asset types, and so you've got payments, loans, real world assets, equities, and so on, can all be in the same place. And the benefits of this are, in the first place, it makes things easier because you have wallet-to-wallet transactions, and it can be cheaper and faster and done at a smaller scale, and these kinds of things. But also, this stuff develops in parallel to the traditional system. So innovation is asynchronous, and this is important. If you think about the way things work in the traditional world, like a new Swift message can take a decade or more to become tested, agreed, approved by everybody, and so on. Now, this open FMI is not going to happen overnight because we need a similar process with testing and with standards. But it can happen in parallel. It doesn't require everybody to change at once. It doesn't require a whole lot of the stuff that goes into a change of a sort of traditional system. And it means that we can start to innovate, and innovators can start to bring assets across without affecting what's going on already, but building that capability in parallel as a complement to the existing system. And as that happens, it starts to build momentum. It starts to create a kind of snowball effect. You start to get the network effect of all these things being together, and you start to create value in this new open FMI system. So this new system, if you start to think about the sort of practicalities, that's nice logic. We've got the money, the regulations all work. We can bring these things together. We've got the potential for a single blockchain with this stuff on. What does it actually mean in practice? Well, if we take this little thing here, which is a US Treasury bill, that's a government debt. That's a debt of the debt of the US government. Effectively, it's like the US dollar is. This is a liability of the Treasury. If we tokenize that, you've now got a tokenized form of that. You've got a tokenized form of that government debt. Because it's tokenized, you can do things with it. If I want to go and buy T-bills, I think I need like $100,000 in sort of, they come in $100,000 chunks. But if I tokenize it, I can buy it in $1 or 10 Rand chunks, and I can just hold this thing, and I can trace my ownership back to the actual instrument. So I've got that sort of security and the stuff that Dale talked about, that assurance of, yes, this token you're holding does link to this thing in the real world. It's similar to the way I might hold I have to trust my bank that they've got my money, or I have to I hold a share with my stockbroker who's got an account with the CSD who actually holds the security somewhere. So it's a similar kind of chain of assurance that we need to create. And we've done this, with US government debt, and you created this thing, which is also a savings instrument, because this pays interest at sort of something like 5% a year in US dollars. So for a South African or maybe a developing world citizen, it's an attractive thing, because I've now got a US dollar denominated thing. I've got a Rand hedge, grows at 5% per year in dollar terms. The Rand typically depreciates over the last 5-10 years at about 7 or 8% a year. So there's 12-13% in Rand terms. So I've got a nice savings instrument right there, just with that tokenized thing. Now, what I can also do is use that tokenized government debt effectively as collateral and issue tokenized money against it. So a stablecoin dollar. So I can do that if I'm an e-money issuer. I can do that one-to-one. I can say I'm going to buy $1 million Rands worth of T-bills, and I'm going to issue. Let's do it in dollars. I can issue $1 million worth of T-bills, and I can issue $1 million of tokens against that, of dollars against that. One-to-one, like e-money works. If I'm a bank, I can hold a number of T-bills, and I can issue far more US dollar tokens against that, because that's how banking works. That's how banks create value for the economy and in lending and so on. Fractional reserve banking, and you can do it here as well. But the key thing is that the government money is right there. It's effectively a CBDC in all but name, this dollar now. The commercial bank money and the e-money, they're actually all the same thing. So they're completely fungible, because when the transaction happens, the collateral in the background is the same collateral that's moving around. So I can now use this US dollar for payments and all sorts of things. I can also take my savings now. So if I'm a South African citizen, I've got my savings in these tokenized T-bills, and I can borrow against them. I can take a collateralized loan against them. That's collateralized, so it's cheap. I can do it for a very short period. I can do it for longer, and the whole thing is automated. So I can do it in very small amounts. If I fail to make my repayments, then the whole thing can liquidate automatically. So because you've got the security that's built in this model, because the whole thing can be automated, It can be cheaper, it can be cheaper rates, it can be done in smaller quantities. And so it created the possibility for somebody to hold a savings and be able to access liquidity against that savings without liquidating their savings. So starting to think about the basis for a new set of products and services and the ability to do things, give access to these tokens, give access to collateralized loans like this, that at the moment would only be available to the very wealthy. So there's a kind of theme here of this inclusivity and opportunity, and from a consumer perspective, from the perspective of somebody buying these assets, that there's inclusivity, but also from an issuer perspective. So non-bank financial institutions and FSPs, at the moment, there's things that they have to use the banking system for, they have to use the card system for, and so on. This gives institutions like that the tools to do some new things, and it gives them the ability to create their own money, to start building their loyalty systems around this. So it starts to create a kind of inclusivity for other financial services players, enabling them to do things they can't do at the moment. And the other thing that's really interesting is if you think about, and again, both of these speak to the kind of Clayton Christensen story of a disruptive innovation. It doesn't come from inside the system. It comes from somebody on the fringes of the system who's not quite able to do what they need to at the moment. The other thing is, if you think at a national level, you're familiar, I'm sure, with the idea that Africa leapfrogged telecoms. So instead of building a bunch of landlines, we went straight to mobile telecoms. It's a better business model. It happens faster and it's modern and so on. And that enables all sorts of things, not least M-Pesa. But it creates an opportunity for Africa that's sort of leapfrogs problems that the more developed world, or arguably more developed world, actually has. We can do the same thing with financial market infrastructure. So in regions and countries where infrastructure is less developed, where stock markets are still very young and small, where the payments infrastructure is less developed, we can build this FMI and roll this out. And it gives the developing, well, it gives everybody, but including the developing market, it gives them access to this global system and to these new tools. And this is very, very brief and very fast, but this is the basis for a Web3 financial services. This is the basis for a new financial world, and this is what we're building. And so you can probably tell I'm very excited about it. So yeah, watch this space. And I'm going to hand back to Brenton now, I think, who's going to run a Q&A for us.
Brilliant. I mean, Paul, that truly was an unbelievably insightful presentation. As you all heard, Paul was largely responsible for leading ops for one of PwC's business units in the crypto and blockchain space. Obviously, as one would expect, they couldn't move fast enough for Paul, so he decided to go and just disrupt all of their clients on his own. These were both unbelievably insightful presentations. For those of you who don't know, my background is in traditional finance and economics, and this has long been one of the most compelling use cases. And I think, in terms of understanding why and how, both Dale and Paul have given us some really immense insight into, remember, the digital disruption of applying blockchain and financial services. And just a quick recap, and before I do, remember, if you have any questions for either Paul or Dale, we're going to go into the Q&A section now, and you don't need to be anywhere specifically. So if you're on Twitter, I know a lot of our viewers are tuning in from LinkedIn, all you do is place your comment in the comment section on your respective platform, and it'll actually come directly through to us here. And here's a perfect example for you. And Dale, I hope you were ready for this question, because the first one from Benjamin comes across from LinkedIn and is for you. So usage of ISO 27001 plus CCSS. So for the audience, it's a specific ISO security standard in IT, and the CCSS is the cryptocurrency security standard. And Benjamin says these two things will hopefully become standardized in the future to enhance security and decrease risks. So what do you think of those audits and those types of regulatory frameworks being applied to crypto, Dale?
Awesome. Thanks, Benjamin, for that. I think, first of all, it is a great stepping stone. It's an indication that globally we're recognizing that this is not going anywhere, and the nature of it is borderless, and we need to come to a standard or a framework that can be applied cross-jurisdictionally in a consistent manner. I think these will, as Paul alluded, is normally the regulatory frameworks are slightly behind, and these will continuously evolve. But it is a great start to ensure that these types of risks and these types of ways to mitigate risk are being noticed, and instead of them being voluntary, becoming mandatory. For example, having segregated funds of collateralized assets to customer liabilities, as an example. If that's legislation, then there's no chance of on lending, because an exchange is not a bank, right? So the way in which people store and custody client funds as a non-banking institution, these types of standards need to be in place, and I think it may not be complete and will be evolving, but in my opinion, I think it is a great stepping stone and a good realization that there is a high demand for this, specifically from a customer perspective, to participate in a safe manner, and it also holds the industry players accountable. And it also implies that we can't have one state or jurisdiction doing one thing that is completely contradictory to a global type standard if everyone buys in. So yeah, I do think this is a step in the right direction. I wouldn't take them as set in stone, but something that we can work with and is better than what has not been existent in the past. So that's sort of my comment on that.
Yeah, thanks, Dale. I think you're dead right. There's no need to reinvent the standards we've got. So if we've got standards that apply to generic stuff like cybersecurity and stuff, then let's use those. We've got messaging formats like ISO 20022, the Swift messaging formats, and those kinds of things. Those we can just bring in. We can reuse those things already. There's no point in reinventing things. So we can bring existing standards into blockchain, but we do also need new standards in some areas. There's a parallel with the regulation here, where you can use some of the existing stuff, but there's also new things that you need that are specific to the technology or specific to the new business cases or new use cases. So it's certainly an interesting area. It's one of those things. It's a lot of hard work, but it needs to be done.
Brilliant. I mean, I couldn't agree more. I mean, these standards have been around for quite a while. But moving on to the next question, and just before we do, thank you very much. That was a great question, Benjamin. So moving on to Dirk, again from LinkedIn. It seems the professionals were very, very interested in today's session, which one would assume to be. So Dirk wants to know, FedNow seems to be going to use the hashgraph technology versus traditional blockchain tech and consensus mechanisms. What is the basic difference, and why do you think that is? So, Paul, I'm not sure if you're familiar with the FedNow initiative and have some color to add here.
Probably not as much as I'd like to be. So I'm gonna check a few things, sort of high level things in. I think there's a couple of things here. One is that the FedNow, the hashgraph tech is not technically not a blockchain in the way that it's built, but that's a technical conversation I'm not going to get into because I don't feel qualified. But they're looking for something that is faster, that is able to handle the volumes of transactions. And level 1 blockchains generally aren't at that kind of scale. And I'm assuming, and I don't want to present this as gospel because I'm making assumptions here, but I'm guessing that they're probably viewing the level 2 solutions, things like optimism and so on. They're viewing those as probably too untested at this stage to be used in something that's out there with real money on it. So that's my reading of it, but I'm not a FedNow guru on this stuff.
Brilliant. No, I think that was a very, very astute opinion. Dale, I know you're often keeping up with the latest sort of occurrences out there in the States. Anything you want to add to the discussion?
So I think the important difference for me is around the open source versus the patented tech. So it's almost as if that hashgraph tech is actually a patented, not open source technology as opposed to the blockchain. But you know, as Paul alluded to, I'm not as up to date with how they're wanting to implement this. Just on the Fed in general, I think, you know, hopefully we start to see precedents being set amongst the actions that have been performed from a regulatory perspective as well, and that will probably shape how we go forward.
Brilliant. No, thank you for adding that bit of detail as well, Dale. So I think what would probably be most fitting, because to be honest, I was one of the audience members that enjoyed the session particularly, is maybe a question that's been sort of ringing deep in my mind, I think particularly after both of the sessions that you've just given. And that is, we obviously all have a very clear shared understanding that given sort of the technical environment and capabilities that we have today, there is a much better systems to be utilized across different payments, whether it be wholesale institutions and central banks or retail, you know, directly with. Why haven't any of these successfully been instituted? And I always like to phrase the question across two sort of specific pillars, is I feel that, you know, one potential answer that always comes back is around the technical maturity of the technology and its ability to handle the scale of some of these systems and the security requirements, which I think speaks very much to what we were chatting to. And the second is, I think going back to Dale's first session, is players don't do anything when it's not clear what they can and cannot do. You know, nobody wants to do something that they might go to jail for in 3 years. Of course, you should go to jail for doing illegal things, but I think everyone on the call understands the point. So from that perspective, Paul, I want to start off from you. Why haven't we got there? And then Dale, I'll move on to you. But starting off with you, Paul.
I think thanks, Dale. I think that's an interesting question, and it's one we're asking ourselves, because we're trying to make these changes happen. Look, it's a financial system. It's important. It's what the economy is built on. We can't just go and switch from one to the other overnight. So there's the sort of behavioural factor, and there's a whole lot of regulated and vested interest in the system. You can argue there's high resistance from the people who have an interest in the current system perpetuating. At the same time, we are seeing it, and that's the point I was trying to bring across in terms of the evolution of money and the evolution of the regulation. Those two things are both happening, and you can see how far they've come, and then you can project that forward and see where they're going. And I think we are heading for blockchain-based FMI. And we can see it in experiments. If you look at the Chinese digital yuan experiment, is probably the biggest one. I mean, I have problems with that, because the first thing they've done is gone straight to programmable money thing, and say, this is great. We can connect your social score to your money, and you can't spend in the places we choose. You're not allowed to, and that kind of thing. So it's a little bit dystopian in some respects, but it does demonstrate that think and work at scale. You know, a pilot in China is tens of millions of people still, so it's still a pretty big thing. So they're demonstrating the stuff does work. But it just, these things do just take time, unfortunately, especially when you're innovating and changing things. If you look at any kind of innovation history, we know it takes a while for stuff to take hold and become mainstream.
No, absolutely. I mean, I couldn't agree more. That very insightful. Thank you, Paul. And Dale, let's hear from the advisory perspective.
Yeah, so I think adoption is an interesting concept, because, you know, in this industry, specifically of late, we take 10 steps forward and we get one bad actor that sets us 20 steps back. And then people market the whole industry as being this terrible place, and investor confidence drops. So I think the impact of participation, and I know we've spoken about maturity, is that we need to get the education part right first. And this may be, quite a different thought, but we sometimes see a complete centralization side and a complete decentralized side. But if we think about it in reality, there's no world in which there's a completely decentralized marketplace in the world globally, in my opinion. I stand to be corrected, but in some shape or form, there's going to be a meld between legacy and the innovative systems, and bringing the existing rails that can be used as a base, that can be supplemented by new rails such as blockchain. For example, cross-border finality, things like on and off ramps, possibly eradicating third world country currencies, coming across with maybe 5 globalized stable coins in order for people to be able to hold their purchasing power. There's so many ways in which it can go, is that I think it is very overwhelming to all industries, all stakeholders, all players, innovators, without any sort of guidance at the moment. It's almost as if it's still that exciting moment of this tech that's landed, where we need to focus on ironing how we bridge that gap. And if you think about, we've seen evolutions in industrial, we've seen the tech evolution. Banking hasn't been changed for a very long time, and we can't expect it to change overnight. And I think education, again, is something that is huge, and the willingness to engage from all parties, is that everyone's going to need to bind them together to create a path forward that creates goal congruency that would eventually drive adoption. And as Paul said, these things take time. We're still very early, and I think once everyone realizes and forgets about the technical terms that are being used, and that inherently happens when something's created, because it's cool. It's like, it's blockchain, it's private key, it's a cryptography, when in essence it's an account number and a password, or it's a user email address, and a PIN, or whatever the case may be. Once we get past that initial phase and get into real world applications, how it changes lives, how it changes systems, how it benefits people in a cost effective efficiency manner, then we'll start to see use cases being built out in a realm of regulated space, and then I think we'll start to see growth.
Brilliant. I couldn't agree with both of those opinions more. I think the summary which is very reassuring, that despite a few setbacks and road bumps that we've had over this very sort of nascent history of the industry, we're definitely moving in the right direction. And I think as we start to see more sort of coherence, both in terms of education, in terms of understanding, in terms of regulatory and operational frameworks, that the puzzle pieces start to fall in place. And this is likely something, in the next 5 to 10 years, we may not even know, but will be implemented in a lot of the consumer tech that we use every day. Brilliant. So I hope everyone has enjoyed today's session as much as we have. I know in the new remote working age, digital fatigue is very, very real. So congrats on sticking around. Remember, if there's any details that you do want to run back on, or maybe you were inspired to do a great post, please make sure you tag us. You can always just rewind the sessions. They'll be available in the next 30 minutes or so across all of these social platforms. And before we do head off today, I just wanted to say thank you, and we wish you all a wonderful evening, and keep an eye on our social channels for the next event. Until next time, have a great evening, everyone.